If you're looking to buy property right now, you're seeing these rates coming, you're seeing expectations, and you're seeing a tightening of auctions. Well, it's a pretty strong signal for most people, I'd suggest.
I think if you get into scarce assets, yes, for sure.
I have spoken to a few investors, Pete, actually, that Sydney-siders that have looked to Melbourne over the last 3 to 6 months, looked at places like Frankston, along the peninsula, kind of end of the train line, so to speak, suburbs that are still really desirable and gentrifying at a pretty rapid pace.
Oh, I'm sure it has. Yeah, I think actually one of the guys at Empower Wealth, Ben Kingsley, was saying that they had an auction over the past week and there was maybe a dozen buyers agents there. G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and for the second consecutive week, I'm here with Mr. Owen Rask from Rask Media, Rask Australia. So Owen, how's your week been?
Good, mate. Yeah, good. Just much of the same. Welcomed a new financial advisor to the team this week. Senior guys, got about 15, 20 years experience. So just getting that done and then going to Sydney next week for a week. So that'll be fun too. What about yourself?
Yeah, nice. What are you doing in Sydney out of interest?
So we'll be doing the rounds as we do in podcast and interview world. We're catching up with BetaShares, GlobalX, hanging out with Raise for a bit. Got some big fund managers and stuff as well that we're catching up with. So PIMCO, a bunch of big fund managers that we try and catch up with at least every 6 to 8 weeks and just hear what they're doing. And occasionally we catch up and do, like a few months ago, we went to the pub with a bunch of rascals and just had a few beers in a pub, and downstairs was Alan Joyce. So some of the team went and got selfies with him. That wasn't long after a bit of a fiasco. So yeah, mate, it's pretty usual for us. We get up every couple of months. All right, every month.
Nice. Yeah, I haven't been to Sydney for a little while. I'm due for a visit fairly soon. So sometimes go down and do a couple of recordings like Sky or Ausbiz and things like that. So definitely overdue for a trip. So much stuff happens out of studio these days. A lot of stuff is done remotely and it's relatively easy, I guess, now to jump on an internet recording. I haven't been up to too much since we last spoke. Just you made me feel bad talking about all your working trips. I've been at the cricket mostly. So but doing a bit of work in between as well. We've been quite busy, I think. We're getting a lot of people come to us with, I think, just with a bit more urgency. We had plenty of inquiry before, but now people are like just saying, can you move us to the top of the list because we want to crack on with it. We want to get something bought before Christmas is a fairly common thing that we're hearing. I guess that's the rate cutting cycle in action, is that people feel like, okay, well, if there's a cycle getting underway, we want to be getting in now rather than competing with everyone as the spring selling season takes hold. We're just sort of getting inquiries about commercial property as well as resi. So we're getting some of the pre-retirees come to us as well, just talking about income streams. And I think it's just a general shortage of property. I think Cotality's figures showed that the stock listings at the moment, they're about 20% lower than what would be normal for this time of year, which when you think about it, that's a big sort of cut out of the available stock. So if you're finding it difficult to find good properties out there, you're not alone at all. And we've had multiple experiences of going to auctions where there's been 15 bidders, 20 bidders. Now that's a very sort of strong market, because somebody buys the property and then you get maybe a dozen people going away straight away looking at the next best property and the next one. So there's a lot of demand out there at the moment. It's not catching too many headlines, but that's certainly what we're seeing at the coalface.
Pete, you mentioned that there's like some people would say like waitlist and whatever that with you guys. What would be the typical timeline? Like if I came to you guys now, made an inquiry on the website to help me buy a place, how long would it take for you guys to start that process? And is there like a long timeline there, or like I imagine you guys are really busy?
Yeah, look, most often we can start pretty much straight away. It just depends on the brief. So, for example, if you're looking to do a commercial property, we've got a couple of those searches underway at the moment, and then they can take a bit of time. So we do have a bit of a wait there. I think for residential property, I guess the one thing we try to avoid is just having very similar briefs, because what we don't want is have two clients looking at the same price point in the same locations. And we don't want that situation. So if that's the case, we do sort of have people on a bit of a wait. But I think for most residential briefs, we can start straight away. And in terms of how long it takes, well, how long is a piece of string? I think for an investor, we found over the years that maybe 4 to 6 weeks is kind of common to get something under contract. Sometimes you find something good straight away and it just works out nicely. Other times, depending on the brief, it could take quite a bit longer. So we're definitely trying to look at pre-market and off-market properties at the moment, as well as what's listed online, because that's one of the areas you can get an edge on the market. If you can find stuff either that's never going to be listed, like deceased estates, separations. Sometimes you get older people who just don't want open homes and things like that. But actually, a lot of the stuff we do is pre-market, where it's going to be listed, but the vendor just hasn't gone through the process of having the professional photography or the staging or getting the property listed. And you're just getting an early look at those properties, and that can be useful too. I think a lot of the stats and the chat in the sort of media at the moment is about the sort of high level of immigration numbers. So the ABS have this like sort of monthly data set, the ABS arrivals and departures figures. And it looks like, of course, you've always got temporary people coming and going, like holiday makers and so on. But if you look at the permanent and the long-term migrants on a net basis, because you've got people leaving too, we've actually been accelerating now for 5 months. I think that's a bit of a surprise. Things were sort of expected to slow down and normalize, but suddenly we've started picking up again. And I think a part of that is just fewer people leaving. I think when you look at lots of other parts of the world, if you look at Canada, big unemployment rate there, nearly 7%. New Zealand's over 5% and rising. A lot of Europe has unemployment. Well, Australia, we're still at sort of 4.2 or so. So I think a lot of people are seeing there's as much of an opportunity to live in Australia at the moment than go somewhere else. So with fewer people leaving, we're seeing that on a net basis, immigration's back up to 450,000, which obviously goes without saying, into a housing shortage. And when they're talking about increasing the student intake to 295,000 next year, it means that a lot of the good work on housing construction is being challenged, I should say, by just the big numbers of people coming and going. I think the government can control immigration up to a certain point, but then you've got this sort of other factors that amplify the cycle when the economy is doing better or worse.
Yeah, there is. Yeah, like you said, more people wanting to stay and looking for accommodation. So it makes complete sense. We've got 3 really interesting stories today, Pete. I know you'll do a bit of an intro to them, but and then we've got a couple of questions on the end. The second topic that we'll talk to today, very interesting to me. When I was reading through the research you sent through, didn't know that this was a way to characterize it.
Yeah, well, let's go through the stories this week. So I think the first one, practically every Sunday/Monday, you get the sort of auction market reports, and usually, there's different ways to interpret them. But I think it would be fair to say that with interest rates having been cut 3 times now, we're in an uptrend for the auction market. So this was covered by AFR and Macro Business and Dr. Andrew Wilson and Domain and realestate.com.au, Cotality. So there's lots of different places you can go to for the info. I think if you look at the stats, well, there are a few more properties actually being taken to auction now. So that suggests vendors are getting a bit more confident about getting a good result. But if you look at the clearance rates, they're basically about the highest we've seen for a year. They're particularly strong in Sydney and Melbourne again, which are essentially the 2 big auction markets. And when you look at the price indices, they're rising basically everywhere. I think, yes, in Canberra, things have been a bit flat over the past year, and Tassie maybe a little bit, but there's nowhere really where prices are falling. Now, when you look at market pricing, the terminal rate for this cycle, if you look at financial markets, it looks to be under 3%. So maybe 2 or even 3 more interest rate cuts priced in, which would probably take the variable rate mortgage down to about 5%. And that's kind of bringing more buyers back into the market. I suppose to take the other side, I just wonder whether we need much more monetary easing in this cycle, or even any at all. I think if you look at a lot of the stats, things like retail turnover, new home sales, building approvals, credit growth is quite solid. A lot of things are starting to actually improve and pick up. Confidence in the business surveys is sort of picking up as well. And for consumers, we've got consumer sentiment at a 3-year high. So yeah, markets are sort of suggesting we need more cuts to come. I just wonder. We'll wait and see how this one plays out.
Yeah, I feel like the market's going to suggest what it wants, right? Inertia is a pretty strong thing in expectations until it isn't. And I actually think that's a fear for mine, Pete, is that rates don't fall as far as people are suggesting right now. Or if they do fall, then they stop, because just not just anecdotally, but just seeing people reacting in the stock market and investing broadly, I'd say the sentiment isn't as one-sided as maybe the medium-term outlook suggests for interest rates.
No, I mean, you're closer to me than this. But I think if you're looking, look at the US, which is kind of the North Star for stock markets. What are we trading out as a price-earnings ratio? I mean, we're right up there. If you look at over the valuations over the past 30 years. And I mean, there's so many different ways you could look at it. Price to sales ratio, kind of record high. Cape ratio, well, it's not quite at a record, but it's pretty punchy. And that sort of is cascaded across markets all around the world, really. We've been in a really strong market since the Trump tariffs originally spooked everybody. And everyone was saying, this is the end of US exceptionalism. And, we're going to see a big downgrade in asset values. Well, suddenly everything's come absolutely roaring back. And it's not just in the stock market. You can see it in cryptocurrencies. Looks like the housing market's picked up. I think in real estate, the office space is not participating. That's they've got big vacancy rates like we talked about last week. But it certainly seems in residential property, there's just not much stock out there. We've had 3 interest rate cuts. I think people can see we've got rental vacancy rates at practically the lowest they've been, at about 1% nationally. And in a lot of capital cities, they're below 1. So, I think it's just bringing in people with a massive sort of confidence boost. But as you said, maybe people are over egging it on their expectations for how low interest rates might need to go. I guess, markets are almost like a weighted expectation. And maybe we do need a bit more help in this cycle. But I'm just, as you know, I follow all the stats as they come out from the ABS every week, and almost every data set seems to be improving to me. And job ads are stabilizing. People are still hiring. So I suppose the question mark is how high will unemployment go? The RBA thinks it will peak at 4.3% by the end of this year and then just basically stay there. So it would be an amazing outcome if that happens. But the skeptic in me says if we're still running sort of big immigration numbers, if you look at what's happened in the UK New Zealand, Canada, we'll probably go above that. But who knows? I could be wrong. Yeah.
But I would say then the setting, just broadly speaking, is pretty positive for property investors in particular, but just property, obviously there's all the changes in government policy around property and suggestions, which we'll talk to in a minute. But I would say broadly speaking from an economic context, the setting is, it's easy to see why people are confident and maybe a bit more bullish right now because, we've got some rates easing and people seem to hold up reasonably well. They've survived the last few years. Rent's obviously gone up and that's been good for landlords. But, I think if you're looking to buy a property right now, you're seeing these rates coming, you're seeing expectations and you're seeing a tightening of auctions. Well, it's a pretty strong signal for most people, I'd suggest.
I think if you get into scarce assets, yes, for sure. I think at the moment we're sort of right in the nadir for the construction cycle. But if you look at the forward-looking indicators, Chris and I were talking a couple of weeks ago, CBA want to get into lending for prefab housing, and the other banks will probably follow. The build-to-rent pipeline is, 30 billion? So there's probably, 40,000 apartments either built or planned or under construction there. We're seeing building approvals by the month, just trending higher again. So yeah, at the moment it feels like we're in a housing shortage that will never be solved. But I'm pretty sure if you fast forward 24 months, 36 months from now, it'll be very different. We'll be in a big building boom again. And that's the way the cycles go. It always seems like when there's an oversupply, it'll never get taken up. And when there's an undersupply, we'll never build enough again. But that's not how the cycle goes. I think the pipeline will swell considerably from here. So if you are sort of piling into the market, you want to try and get into really sort of quality investments with scarcity value, really, because at some stage there will be a big building boom, and most likely high-rise towers in some of these sort of inner suburban areas. I guess there's certain areas where the zoning allows for it, and we'll get a big construction boom. So yeah, I guess, but at the moment, shortage is the order of the day, and yeah, it's bringing a lot of people into the market.
So do you think that if you take that, is it a 2 to kind of 4 year view where you see things maybe easing and the narrative shifting a little bit? Is that the kind of timeline that you're working to?
Well, if you look at interest rates, which is often a sort of a key barometer, because every rate cutting cycle has ultimately ended up in nominal prices rising. I think it was the early 90s recession was quite brutal. And in that instance, housing markets were pretty shallow in terms of their recovery. But almost every other time interest rates have fallen, nominal housing prices have basically gone up. And in some cases, they've gone up a lot. But yeah, so if you look at what markets are pricing, it's for a fairly shallow rate cutting cycle. And yes, interest rates might be down over the next, say, 12 to 15 months, but then they could bottom out. So yeah, maybe then the market starts to lose some momentum after that. So I think sometimes, yeah, if the market's in a boom cycle, it continues. But yeah, I think in terms of the supply, I mean, it's taking longer than it should at the moment to build housing. It's detached housing is taking maybe a year. And for sort of the medium density stock, it's really up to 3 years to actually see it really hitting the market. So it's brilliant that we're seeing more approvals at the moment, but it might be 3 years before that really starts to hit the market. We've seen construction times blow out in recent months for various reasons. So, but yeah, I mean, it always feels like, we'll be in a sort of an endless shortage, but every shortage is followed by a glut. That's just the way these things go.
Yeah. The interesting thing, which I know we wanted to talk about, was our second story of the day, which is that every rate cutting cycle is different. And you referenced a whole heap of literature here about not just recent times, but I think, a couple of decades worth at least. So I think this is a really interesting point for us to riff on just generally, Pete.
So Nerida's researcher, Ray White, has shown that every rate cutting cycle is different. So 2015 to 2016, we saw a shift to affordable markets. So New South Wales Central Coast, Avoca Beach, Copacabana, Foresters Beach, the Entrance, typically suburbs from 800k and upwards as people looked for coastal lifestyles away from Sydney and a bit more of an affordable sort of commutable distance. The 2019 to 2020 cycle was, well, it's hard to remember, isn't it? Because we had in 2020, first we had shops closing, then we had lockdowns, and some cases in some states quite draconian lockdowns. And then we got the Reserve Bank trying to build a bridge across to the other side. And we got unprecedented rate cuts. And even though it's hard to remember now, the initial response was strongest in Sydney's premium suburbs. So Turramurra, Castle Hill precincts, Northern Beaches, Collaroy Plateau, Freshwater, Brookvale. All of those suburbs went basically gangbusters. And then as the pandemic continued, we got the COVID race for space because it just drove demand outwards. I had friends in high-rise units in inner city areas, couldn't use the lifts, couldn't use the amenities. People wanted outdoor space and fresh air. And eventually that drove demand out to the regions. Now, this rate cutting cycle is interesting. We're beginning from the highest interest rates in over a decade. And I mean, so far, it's been all about the sort of the mid-sized capital cities. Brisbane, Perth has been going gangbusters. So Midland, Guildford, Mandurah, basically all of Perth. Adelaide's affordable outer suburbs as well. So areas like Smithfield, Elizabeth North. So yeah, I think that's what's happened so far. I guess the interesting question is what happens from here. It feels like at the moment a lot of investors are piling into Melbourne for its relative affordability. And I often find the Sydney market is driven by confidence because there is so much wealth and so much equity just sitting around in Sydney that when people decide to deploy it, then markets can take off and boom. And maybe that's more of a confidence thing. So yeah, it's interesting how, as Nerida shows, every cycle has its own characteristics. In recent times, it's been the sort of middle-sized or medium-sized capital cities, but maybe things are starting to shift a bit towards Melbourne and possibly Sydney as well.
Yeah, it's really interesting. Because you think about the characterization of the data, like through in different cycles. I remember that in particular, that boom in COVID in Sydney, and I remember thinking about those numbers. But then obviously more recently, we've seen, as that confidence has kind of evaporated over the last, say, 3 years, you can see some of those places like Paddington and out east. You can see that in the data that suggests that some of those areas have had a bit of weakness based on lower volumes probably, but you can see that coming back the other way. So I have spoken to a few investors, Pete, actually, that Sydney-siders that have looked to Melbourne over the last 3 to 6 months, looked at places like Frankston along the peninsula, these types of kind of end of the train line, so to speak, suburbs that are still really desirable and gentrifying at a pretty rapid pace. I think they were quite trendy areas, to be honest, with some podcasters and that type of thing too, some people on the interwebs. So, but I've seen a lot of activity in these types of kind of outer ring type of suburbs here in Victoria, and I'm not sure if that's played out in the data, but it's definitely something anecdotally that I've been hearing.
Oh, I'm sure it has. Yeah, I think actually one of the guys at Empower Wealth, Ben Kingsley, was saying that they had an auction over the past week and there was maybe a dozen buyers agents there. So yeah, I mean, these are sort of anecdotes, but that is what I'm hearing too. A lot of people, investors, particularly where the budget's a bit constrained, they're finding there's more opportunities or more options in Melbourne than in other parts of the country. And certainly versus Sydney, it might be the difference between buying a house in Melbourne versus a unit in Sydney, and hence the shift. So yeah, we'll see how that plays out for the rest of the cycle. So third story this week before we come on to your listener Q&A, the productivity roundtable kicking off this week in Canberra. So we'll have to see what comes out of it. So Sky News did a piece this week with a couple of academic economists calling to introduce capital gains tax on the family home or potentially imputed rent. The Australia Institute wants to tax everybody that moves with a wealth tax. So no mention of cutting government spending, of course, or anything like that. So tax is the answer to everything, it seems. I think, some of the things we already know will be sort of tabled. The unions will be keen to discuss the potential for a 4-day working week. The Victorians want working from home 2 days a week, but I don't think these are things that are really productivity gains as such. I think, I'd be interested to know your view, Owen, as someone who runs a small business in Australia or increasingly a not so small business. Where do you think the red tape could be reduced? A lot of people complain about complicated employment laws and this sort of salary system. I remember in my days as an FC, I could never work half of this stuff out. You know, you're always second guessing whether you're paying people the right amount. With the award system, you got annual leave, long service leave. It seems very, very complex. And I guess for someone in financial services, you've got issues with licensing, regulation, professional indemnity. Where do you think there could be improvements?
Yeah, it's hard to speak broadly across all businesses, but I do speak to a lot of business owners. For us in particular, obviously we're in the most regulated of all the industries, which is finance and that type of thing. We pay tens of thousands of dollars in insurances just for weird things that you've never even thought were insurable. Probably maybe $100,000 or more in just random insurances. I thought about this a lot actually coming into today. Probably the one that's most important if we think about productivity as a country, there's over 2 million small business entities or micro business entities. I think employment law is definitely something that is incredibly difficult to navigate. And we live in a very employee-focused world now, whereas maybe 20, 30 years ago, we were slightly right-leaning in the way we approach business. And, I thought about, like, is there a simpler, fairer system? I don't know, someone's going to shoot me down for this for sure, but I thought, one of the things that you could see that works really well in the United States is companies that have different hiring and, dare I say, firing practices, where they might, for example, have a practice where that if they let go of someone, they give them a minimum amount of pay because they recognize for that person it's a risk in their well-being. And so, like, for example, this is an extreme example, but in the Netflix business, if you're fired, no matter how long you've been there, you get a minimum of 4 months' pay. And that makes everyone's life easier. It gives you time to go and find and reset, in a new business, but also then enables the business to be more flexible, knowing that they've got a responsibility to this person. But it's very clean and simple to understand, something like that. So I feel like that's a big one, just employment law in general. The thing that blows my mind, and this is only some people, again, will probably shoot me down for this, is just payroll tax. I cannot believe payroll tax, Pete. I don't know if you've ever come across that, but once you get to a certain threshold of paying people, which is an absolutely wonderful feeling to being able to give someone a job, by the way. I think that's a wonderful thing for business owners. But once you get to a certain threshold, instantly you pay 5% to the state government just for no reason. Literally just for no reason. Like, you just give them 5% of your entire payroll every month. Here's your payroll tax. And I just think that if you're looking for businesses in that kind of small to medium size and those types of taxes, and you're wondering why don't we have more competition in these key industries, that would probably be the big one for me. It's a really subtle thing and nuanced, but I can't believe it.
Well, the UK government has actually recently been trying to balance the books. The budget's in deficit there, and they increased employers' national insurance. And of course, ever since that time, hiring has gone down the plug hole. So it shows, I mean, of course, that's not the only factor, but it hasn't raised any tax because employers are just less likely to hire people. I think in terms of how this filters into the housing market, I guess, the participants in the housing market certainly used to be the case. Before 2007, there was a range of ways to borrow. There was things like, you could do low doc lending and things like that. Then things got a lot tighter. So for an employee, if you've got a secure role, full-time role, you got pay slips, that's probably the easiest way to borrow. I think for self-employed people, yes, you really need a broker on your side to navigate that. Look, it is different. I think a lot of people in Australia in recent years have tried to employ people more so as contractors to get around some of those sort of difficult rules. But then, I think if you've just got somebody who's only contracting for you, the ATO is going to look at that and say, look, the principle, definitely, the substance of this over form is basically you've got an employee and therefore you have to treat them accordingly. So, look, it'd be interesting to see what comes out of this. I mean, the housing market is a big target. They've explicitly ruled out looking at negative gearing, but capital gains tax might get a look. It could simply be a lot of hot air. So we'll have to wait and see what the media reports over the weeks ahead.
I know that Scott Phillips was talking about the CGT on the family home a lot over on X or Twitter. I was curious to actually pick your brains on this really quickly. Do you think that that's something that is on a genuine on the horizon, taxing the family home for CGT purposes?
I don't think so. I mean, it doesn't really help. If you're trying to make the economy more productive, why would you make it harder for somebody to move home? It doesn't. From that perspective, doesn't make sense. Like stamp duty, it's a bit of a dead weight tax in that regard. Look, some countries do have capital gains tax on family homes, but then they probably have mortgage interest deductibility at the same time, which we don't on the family home. So, I think it'll be politically difficult. I saw in the polls, the Labour Party is polling 59% two-party preferred at the moment. So if they ever had the opportunity to make some grand reforms, now's the time to do it. They've got the political space. But he said he wouldn't.
He said he wouldn't. Don't take a politician at their word, but he said he wouldn't, which is the great irony of it all, right? So, like, if you have the votes, why wouldn't you make change?
Yeah, I don't know. I think it's a difficult one. It's like with death duties in Australia. In Europe, people are just used to it, but in Australia, people don't want inheritance taxes. So it will be a politically difficult one to navigate. So we'll see what comes around. So we've got time to cover off just a couple of your questions in the listener Q&A. So first one, this question is right up your street, actually, Owen. So this is from Reduce, Reuse, Recycle. Debt recycling, what are the investment choices? Can it be used as a successful small business strategy or part of a successful small business strategy? So, for example, if I had 12 months of funds ready to go to start my new business or turn my side hustle up to 150%, why wouldn't I debt recycle and invest the money into my own business? Pros and cons. Well, I guess to start with the obvious one, a lot of small businesses don't make it, frankly. I haven't looked at the stats recently, but obviously, I think it's sort of well known that a lot of small businesses fail. I think, look, I've had numerous business ventures that have gone nowhere, and sometimes it's not necessarily, the big sort of collapse that you kind of might envisage. Sometimes it's just an idea that goes nowhere, so, and that potentially is a risk. If you started sort of recycling debt into your own small business, you just have to think through, some of these sort of implications if it doesn't work out as planned. So, I mean, I know you've got some experience in this area. What do you think?
Yeah, I agree. First thing first, I agree with you, Pete. First thing first would be like we're only speaking generally on this show. If you want advice, get to your broker and accountant and financial advisor and all that. But I think that if someone was to say to me, I've got 12 months worth of funds ready to start a business, thinking of debt recycling, and I would just be thinking, what the heck? Have you ever run a business? Because I don't mean to be rude, but most of the time, a business, you have a budget for a business and you got to triple it, and you got to find sources of funds and blah, 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 blah. And so incrementally, the benefit of putting your money at risk is simply not there, because say you've put your money in the share market and it's quite risky. You might get, let's hypothetically say you get a 7% return after tax, 8%. There's obvious benefits to debt recycling from a tax deductibility perspective, but let's say you get interest deductibility. Let's say you get 7% return. At the moment, what's ING offering? 5%. Macquarie's probably offering something similar for a savings account. There's not, like, you're not simply dealing with puts and takes here from one side to the other. You're dealing with that margin. And so your margin that you're trading off is the 2% potential gain against a potential significant fall. We know on average the stock market falls once in every 5 years on average, and sometimes multiple years in a row. So I would not be putting two things in the risk bucket at the same time. I'd be more thoughtful about that. The other thing that I'd probably say here, just what is debt recycling generally speaking? Debt recycling is just using the equity in your mortgage, your home primarily, to then invest in other things. It's just the same as buying an investment property on equity. You're using that equity to invest in typically ETFs that pay dividends and that sort of stuff. So the interest has a tax advantage, like your tax deductibility, and you get franking credits from the ETFs as well. So that's what I see really common. The best debt recyclers I know have a limit on how much they borrow, and I haven't seen one of them do it on a small business that is yet to be formed. So great question. I just think it sounds very, very risky. So I'd reach out to a professional before going down that path, Pete.
Sound advice. We've just got time for one more question from Auction Advice. I went to an auction in Brisbane this week, and there were nearly 20 registered bidders. Obviously, I missed out. What should I do? Help. We're not completely unfamiliar with the challenge, because we've had similar experiences in recent weeks. Yeah, so look, I think, at the outset, do your research. Get clear on the research, and particularly the brief. So if you find a property that you really like, you can act decisively on it. Now, most property in Brisbane actually doesn't go to auction. It's sold by private treaty. So in that instance, you're probably going to need to move quickly in the current market where stock levels are low. All of the due diligence you can do ahead of making an offer is probably useful at the moment. If you make an offer with lots of conditions, like 2 weeks of due diligence and a finance clause and a building and pest clause, I'm not saying you won't buy a property, but it will be harder to get the one you want. I think, there's no sort of magic bullet here, but in particular, I would talk to agents. If you know roughly, I don't have much info here, but if you know where you're going to be buying, the sort of range of suburbs, you need to get into the ears of the agents locally and tell them, look, this is my budget. This is what I'm looking for. Do you have anything coming up? Or if not, can you let me know when you've got something coming up so I can get first look at it? Because you may well be able to buy properties before they're listed online. It doesn't have to be listed on Domain or Real Estate. You could actually buy something that's just been prepared for sale, or sometimes there are silent sales that are never going to be listed. If an agent thinks you're a serious buyer, they could potentially tap their list. I think if a property goes to auction, like there's, reams have been written about bidding strategies, about, bidding, join in late or bid strong or slow the bidding down or speed it up. There's lots of different bidding strategies. But to a certain extent, if there's a lot of bidders and people with deep pockets, there's not much you can do. I would just say that if you're going to go to an auction and bid, you've just got to know your limits and bid strong and confidently. And don't sort of whisper to your partner, because that's sort of suggests you're about to sort of tap out on your budget. But I think if you go to an auction and there's 20 bidders, well, you can see straight away the matter against you. So I would say if you can buy private treaty property or pre-market or off-market property, you probably have more chance of success. And if you do go to auction, just give it your best shot, but do know your budget. What do you think, Owen?
Yeah, I think your first comment there was absolute gold, Pete, is that if you have your brief, you have confidence. So if you have your brief, then there's going to be something else that pops up and you know what your limit is and how hard you can go. We see the same thing in financial planning for what it's worth. If someone has a plan, they have way more confidence to take an action during uncertainty. And so that requires a bit of thought up front. The brief is much the same. So just having that plan gives you conviction. And I think that a lot of positive things lead from that. So I think we're going to see more of this, because we talked about, auction clearance rates and some supply issues, rates and expectations. I think this is a bit of the new norm. But I think you also hit another nail on the head there, where you said the amount of that are off market. So using a good buyer's agent is, I know I'm talking up Pete's book here, but this is where his business operates, right? That's where you get that type of experience, someone that's already done all those connections for you and has the relationships. So I'd say reach out to a BA in your area that you trust.
Fair call. So just to wrap up this week, markets are pricing for the cash rate to go under 3%, but I'm not so sure. I wonder whether we might only get maybe one more cut. Maybe we don't get any at all. So let's see how that plays out over the rest of the year. Don't forget you can join us at the Rask Community Forum. That's community.rask.com.au. Completely free. And it's not just property there. It's stock markets, business, finances, you name it. It's all there. So great free resource. Owen, what's on for you? Any weekend plans?
Not too many weekend plans, Pete. I'm hoping to have a bit of a quiet one, but I am off to Sydney this week, so that's a bit of a stretch. Next time I'm going to Sydney, I'm actually taking the family with me, and we're staying in Double Bay. I've never been there. I know it's a very nice area, so hopefully there's a few nice cafes if someone wants to write in. But other than that, I'll probably just be enjoying Alcove's new website. I've got to admit, Chris is off gallivanting in the UK somewhere, much like yourself, Pete. Maybe say good day to him. But I'll be enjoying his new website because it's an absolute crack. I know we all know Chris loves a new website, but this one is probably the best yet. So I'll be enjoying that.
Yeah, if you're in Double Bay, don't forget you can get down the Great Barrier Reef down there, the Golden Sheaf. It's probably a bit nicer these days. It's probably a bit more upmarket. It used to be absolutely hectic down there, probably not so much of a family venue, but I think a lot of these places have been upgraded since my drinking days. So it's
I'll check it out. I'll report back. What about yourself, mate? What's on for the weekend?
I'm going to the Cotswolds, so I'm going down to Clarkson's farm, and it's a bit of an internet black hole down there, so I'll be offline for 4 days, which is, I think, good. It's sometimes difficult to step away, so
wonderful part of the world.
Yeah, it is, and then I'll be off to Perth pretty soon after that. So I've got a week in WA coming up, so it's all good. So send in your questions. Always love to cover your listener Q&As in the 2 cents, and I'll be back next week. And enjoy your weekend. Thanks, everyone. Thanks, Owen.
Thanks, mate. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or If you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.